What's up everybody, I'm Jaspreet Singh, and the Federal Reserve Bank finally started raising interest rates for the first time since 2018 to start fighting this massive inflation that we're seeing. And I waited a little bit to make this video because I wanted to see what would happen after the Fed raised interest rates. And we got an interesting warning from the Federal Reserve Bank that you want to be aware of. You might remember back in 2021, the Fed kept saying that inflation is transitory until they finally came out and admitted that inflation was not transitory. Well, now, the latest prediction by the Fed is that inflation is going to come down to 2% in the near future.
We expect inflation to return to 2%.
The original plan was inflation to come down to 2% by the end of 2021. Then it was 2% by the end of 2022. Now the Fed is saying that we're going to see inflation under 3% in 2023, and then it's going to ultimately come down to around 2% not too long after that. Now at first glance, this might seem like good news. The Fed says we don't need to worry about inflation, and then inflation is going to be under control and it's going to come down in the near future. But if we look a little bit deeper, we're seeing some bright red warning signs by what the Federal Reserve Bank is saying. I mean, for one, the Fed said that inflation is going to get worse before it starts to get better. Oh, and our dollar is also losing some of its status and power around the world, but I'll get to that in just a little bit. Let me start by diving into what the Federal Reserve Bank said, because they said that inflation is too high right now. In fact, it's worse than what the Federal Reserve Bank expected, and because it's so bad, it is going to get even harder to fight inflation, especially if it gets worse than what it is right now. This is why the Federal Reserve Bank is raising interest rates. They raised interest rates by 0.25% to help fight inflation, and they said that if inflation gets too far out of hand, that they will raise interest rates more aggressively, and they'd be willing to raise interest rates faster. Now let's go through this critically, because the Federal Reserve Bank says that they're going to raise interest rates dependent on three different things. They're going to look at the strength of the economy, they're going to look at the strength of markets, and then they're going to look at inflation to see how fast and how much they should raise interest rates by. They look at the economy because the Fed wants to make sure that the economy can support a higher interest rate, because when you have higher interest rates, it becomes more expensive to borrow money, which ultimately slows down the economy. I mean, the easiest way to understand this is just to look at the housing market. Now that the Fed has raised interest rates, we've seen mortgage rates go up pretty quickly. Well, now that mortgage rates are more expensive, it makes it less attractive for somebody to go out and buy a home because it's just more expensive to buy a home. But the Fed has said time and time again that our economy is robust and it can handle higher interest rates.
The economy is very strong.
So this part checks off. Our economy can definitely support raising interest rates according to the Federal Reserve Bank because of how robust it is. So let's move on to markets. Now it's not really a surprise that the Federal Reserve Bank is looking out for the back of investors. They can't technically say that because that wouldn't look good for the American people, but that's what they do. I mean, if you remember when the 2020 crash happened, the Federal Reserve Bank opened up the money printer and they said that they would print an unlimited amount of money to help support asset prices, to help support the stock market. Now when they do that, they cause more inflation, which hurts the average person, but at least stock prices are higher, right? So the Fed doesn't want to hurt the markets, and if they went out and they started to surprisingly raise interest rates, it would be a shock because now the economy is going to slow down and that wouldn't be good for markets. But that's not what happened now. Everybody knew that the Federal Reserve Bank wanted to raise interest rates. I mean, we've been talking about this for months, and most people were actually predicting a 0.5 percentage point of an increase when it came to interest rates. But then the Fed came out and they only increased interest rates by 25 basis points, meaning 0.25%. So the markets were definitely prepared for an interest rate hike. They were prepared for an even bigger interest rate hike, but the Fed came out with a 0.25% interest rate hike. So what that tells us is the markets are prepared for higher interest rates, but the Fed didn't want to raise interest rates that high yet. This brings us here to inflation. We are facing the worst inflation crisis that we've seen in 40 years, and now we also have an energy crisis with everything going on overseas, making gas and energy prices so much more expensive. So we have a major inflation problem, and the Fed has said that if inflation continues to get worse, that it's going to become even harder to fight. But at the same time, the Fed has also said that inflation is going to get worse before it gets better, and then the Fed said that we will fight inflation more aggressively if inflation gets worse. And this is where things are really not adding up, because we have an economy that is supposedly strong and stable enough to support rising interest rates. We have markets that are predicting and ready for rising interest rates, and we have inflation that needs rising interest rates in order to fight it. But the Fed is still saying that they will start raising interest rates more aggressively if inflation gets worse. This is where things don't make sense. Because we have raised interest rates by 0.25%, but that's nowhere near enough to start fighting the actual inflation problem that we have. I mean, if you really want to fight this inflation that you have, we have to raise interest rates pretty significantly. Back when we were facing the inflation problem in the early 1980s, the Federal Reserve Bank had to raise interest rates to over 20% to fight the inflation problem, and that was the way that they were able to save the strength of the dollar. Now, we're facing a similar inflation problem, caused by different things, but we're facing high inflation, and the Fed has only raised interest rates by 0.25%, either because they're worried about this and they're not telling us, or because they're not ready to start fighting this yet. If the Fed really wants to do what they say that they're going to do, which is fight inflation, then they would be doing what they need to do to fight inflation, which is raising interest rates. Now, they're not doing that. A 0.25% interest rate hike is not going to fight the 8% inflation that we're seeing right now. We would need significant interest rate hikes to fight inflation. So what that means is maybe the Fed is a lot more concerned about the economy than we think, because the economy is what the Fed is basing whether they're going to be willing to raise interest rates or not. The Fed keeps saying that our economy is robust, our economy is strong, our economy can handle higher interest rates, but if it can, and inflation is so high, wouldn't the Fed already be raising interest rates right now, considering how high inflation is? You can't fight this and support this at the exact same time, because when you raise interest rates to fight inflation, you ultimately hurt the economy, because now it becomes more expensive to borrow money. That's why when you enter a recession, you cut interest rates to support the economy, which ultimately causes more inflation. So you can't do this and this at the same time, and right now, the Fed is really concerned here and here, but they keep saying they're concerned here, but they're not doing anything to support this. The reason why this is such a big concern is because you have to understand what inflation means. Inflation isn't the prices of things going up. Inflation is the value of your dollar going down. And because the value of your dollar is going down, you need more dollars to go out and buy things. Well, if you look at the United States on a global presence, the United States is the world's superpower. We have the world's reserve currency. But that is now being challenged. I made a video recently talking about Ray Dalio's theory of how China might become the next world order, and we also have countries around the world that are starting to ditch the dollar. Even Saudi Arabia is talking about potentially not using the dollar to buy and sell oil. I don't want to go too deep into the history behind the petrodollar in this video, but essentially the dollar is what's used to buy and sell oil around the world, and if that no longer happened, well, then the United States dollar would lose a lot of its credibility around the world. And if that were to happen, then the United States dollar would lose even more value, causing more inflation, making this whole problem a whole lot worse. There's two major things that I want you to get out of this video. One, inflation is going to get worse before it gets better. Do not expect inflation to just magically disappear. This problem is going to continue to get worse for at least the foreseeable future before we start to see inflation cool down and before inflation no longer is an issue. So this is going to be a major problem when it comes to money. Things are going to get more expensive. Life is going to get more expensive. So prepare for that. Don't wait for it to happen to start thinking about what to do. Start preparing right now. Get your finances in order. And second, the next 50 years of our economy are going to be very different than the last 50 years. So use your money accordingly. Our parents and grandparents grew up in a very different time in the American economy and a different phase in our American economy. During the last 50 years, we saw huge growth in the American economy. We saw massive innovation. We saw massive success in the American economy. Now, over the next 50 years, the American economy will continue to grow, but we're probably not going to see the same growth that we saw over the last 50 years. And we could see a lot of changes with things that happened to the dollar. We can see a lot of changes to the presence of the United States around the world. We can see a lot of changes when it comes to the world order of the world's reserve currency. These are things that you want to be aware of and that you want to be prepared for, because the people that are going to get hurt and lose the most are the people that get hit blindsided because they expect everything to continue to work in the future as it has in the past. You cannot drive a car by looking at the rear view mirror. You have to look at what's coming ahead of you, and you want to start preparing your money for what's coming. That means, for one, you do not want to be 100% in cash. You do not want to just be saving all of your money, because this inflation is not going away. When you see inflation happen, the value of your dollar goes down. So if you're just saving all of your money while your bank is paying you nothing in interest, you're effectively becoming poorer each and every day. So you do not want to be saving all your money. You need to be invested. Now, you can invest your money in different places and you need to be diversified. You don't want to have all of your money in one place. So you want to have some money in stocks. But even within your stock portfolio, you don't want to have all of your money in just American stocks. Consider having some money in emerging markets, that way you're not just exposed to one economy. You can have exposure to different economies. You want to consider having some commodities, things like physical gold. Now you got to remember, when you invest in gold, the goal isn't to see a massive return on your money, it is a hedge. Gold is an inflationary hedge to protect you against really anything. Then you want to consider also having some hard assets, things like physical real estate, because now you own something that you can see, feel, and touch, and you have something physical, right? So now you have a physical asset, you have some commodities, and then you have some equities, some stocks, and these are not just stocks in the United States, you also have some stocks, not your entire portfolio, but some stocks outside of the United States, because we're gonna see a lot of changes and a lot of volatility over the next number of decades. The losers will be savers, because your money is being eaten away by inflation, and as the financially uneducated, because you're gonna get blindsided by all the changes that are happening, because we're seeing a lot of changes happen, and you need to be aware. You can't just blindly listen to and believe what the Federal Reserve Bank says. They said inflation would be gone by the end of 2021. Here we are in 2022, and inflation keeps getting worse. There's one more thing that I want to mention about inflation, and this is really important to understand, because there's a lot of misconceptions out there about what causes inflation, what makes inflation worse. But before I get into that, if you want to stay on top of what's happening in the finance and business world like this, you can check out marketbriefs.com. Market Briefs is a free financial newsletter that I created. I am the CEO of Market Briefs, and the way it works is every day my team breaks down what's going on in the top finance and business world into a fun and easy to read newsletter. You can read the newsletter in just a few minutes every single morning, and it's completely free. So if you want to join Market Briefs, you can go to marketbriefs.com, and I'll also link it for you down in the description below. Most of the time when you talk about inflation, people assume that inflation means the prices of things going up. But the price of things going up is a byproduct of inflation itself. Inflation is when you inflate the monetary supply. It's when you increase the amount of dollars out there. That's why the word inflation comes to the word inflate. So what are you inflating? The monetary supply. When you increase the monetary supply, when you just print a whole bunch of money without any increase in wealth, so if you're just printing pieces of paper, the value of each individual dollar goes down. So you print more money, the value of each individual dollar goes down, which in turn causes the price of things to go up. That's what causes inflation. And one of the big reasons why we're seeing so much inflation right now goes back to 2020. Yes, we have a whole bunch of supply chain issues going on right now, but what caused these supply chain issues? They didn't just magically come out of nowhere. Well, when the pandemic hit, we had an economy that was shut down. Our whole economy was not working, nobody was producing anything, but the Fed and the government kept producing more dollars. We kept printing money without producing any value. So you print money when no one's actually earning or producing anything, you give this money to people, and now you're not working to produce anything, you're not working to earn money, but you have money in your pocket to spend, so now you spend. Now you're spending money and buying things, but nothing's being produced, and what does this cause? Well, now a supply chain mess, because everybody has money to buy things. You have a whole bunch of money to buy things. You're buying things even though nothing's being produced. So now you have a whole bunch of demand and no supply. And now this creates a supply chain mess because you have this free money. And now you have bottlenecks starting to form because now you have all these manufacturing plants that are shut down and people don't have products to sell and people are buying everything that they can. And you're willing to pay a higher premium for things because you have the money in your pocket. So this is what started all the supply chain issues, and now we're facing the consequences because of that. So it went something like this. We had all this free money be created and printed by the government, which caused the supply chain issues because now people were buying things even though nothing was being produced. Now you have these supply chain issues, and this caused the cost of things to increase. Because now, not only you have a tough time sourcing your raw materials, but you have to pay people more money to come into work, causing the price of things to go up. Now the price of things keep getting more expensive, not only because you have all this money entering, but because it caused supply chain issues. The businesses have to charge more because they have a lower supply of things. And now people have to start charging more money. You started to see wages start to go up more significantly. Now that people are making more money, they go out and they start spending more money. So now people are spending more money and they're willing to pay the higher prices of things, even though still we're facing these supply chain issues causing the price of things to go up even more, while free money is still in the system. We're still facing some of the lowest interest rates ever, which continually keeps causing more and more inflation because more and more dollars keep entering our economic system, which is starting to create create the spiral. This is something that the hedge fund manager and billionaire Ray Dalio talks about, is that right now we are facing this spiral where we're just creating more supply chain issues, causing the price of things to go up, causing wages to go up, causing more supply chain issues. And this is something that we're not going to be able to fix unless we start to raise interest rates and we start to tighten the monetary supply. And we have to do this much more aggressively if we really want to get inflation under control. But the ultimate root cause of inflation is not the supply chain, it is the amount of dollars out there. The supply chain issues are a byproduct of the monetary policies that we have. It is not the cause of the monetary policies that we have. If you enjoyed this video, here's a video on the changing world order that I think you'll love, and while you're at it, you can subscribe to my Market Briefs newsletter for free by clicking that button below. Thank you for watching, and as always, keep hustling and continue funding their operations, because when you don't have enough money to fund your operations, you don't have enough gold, what do? Well, you severed the gold standard, then you just print more money.